Welcome back to the channel. Today we're diving deep into an essential market update featuring insights from Tom, Lee's latest CNBC interview. He's laid out 4 major stock picks and examined the ongoing tech stock dip, shedding light on why it could serve as a golden buying opportunity for astute investors. This is the moment to recalibrate your portfolio as we explore the factors shaping today's market: skepticism, inflation fears, potential Federal Reserve rate cuts, and the impending implications of tariffs. Tom Lee has unveiled 4 new additions to his Granny Shots list, a carefully curated selection of stocks he believes will flourish in the long run. First on the list is Amazon, a powerhouse in e-commerce and cloud computing, which continues to innovate and expand into AI-driven services. Next, we have Meta, the parent company of Facebook and Instagram, investing heavily in virtual reality and AI technologies, ensuring sustained user engagement and robust ad revenue. Let's not forget JP Morgan, a veritable giant in the banking sector, with strong financial stability, ready to navigate economic cycles. Completing the quartet is SP Global, providing vital financial data and analytics that fuel informed market decisions. What makes these stocks stand out is their resilience and industry leadership. These companies possess structural advantages, including strong revenue streams, expanding profit margins, and a commitment to innovation. They are not easily swayed by economic downturns, making them strategic long-term investments. As we venture further into uncertain market territory, holding these stocks could prove to be rewarding for those willing to weather the storm. Moreover, Tom Lee emphasizes that market skepticism could actually be bullish for wise investors. In a climate where fear dominates, we often find some of the best opportunities hidden in plain sight. As history teaches us, the greatest investment strategies often originate from market adversity. Lee draws an apt comparison to Warren Buffett's wisdom: be fearful when others are greedy, and greedy when others are fearful. With the fear-greed index currently reflecting a state of fear, it's the perfect time to consider these high-conviction stocks, as patient investors stand to gain substantially from this market dip. As we wrap up, remember that these insights from Tom Lee not only shed light on emerging opportunities, but also set the stage for discussing our own stock picks that could outperform in 2024. Let's keep an eye on these developments, as now is the time for informed decision-making that aligns with your long-term investment goals. Currently, there exists an astonishing $7 trillion in cash parked on the sidelines, exhibiting a deep trepidation among investors. This cash indicates potential for reinvestment, waiting for signs of confidence to return in the marketplace. Once that confidence is restored, the financial pulse of the stock market is likely to surge, as this substantial reserve of cash flow into equities, propelling stock prices higher and contributing to a robust market rally. This is a cyclical phenomenon. History reveals that what often begins as worry morphs into a positive push for market performance. Market volatility is a well-documented aspect of investing, with history showcasing consistent rebound patterns after dips. From the recent CPI panic to notable tech declines and tariff-related uncertainties, markets have demonstrated resilience and the ability to recover strong post-shock. Investors who adopt a proactive approach, buying when prices dip, frequently reap substantial rewards over time. This buy-the-dip strategy echoes across generations of investing wisdom, illustrating a sound principle in navigating market tumult and volatility. Furthermore, the ongoing inflation concerns are overstated. Tom Lee highlights how heavily politicized inflation surveys distort public perception, resulting in differing views dependent on political affiliation. While Democrats fear inflation escalating drastically, Republicans dismiss its significance almost entirely. The reality points towards a more moderate inflation rate, lingering around 3%, which, although above the Fed's ideal target of 2%, does not suggest an impending crisis. Key indicators such as oil prices, currently stable around $70 per barrel, and potential tariff implications will remain critical to watch, as they hold the key to inflation dynamics going forward. As for tariffs, market apprehension surrounding political strategies from former leaders, like Trump's historical approach to tariffs, is often exaggerated. His past tactics indicate a tendency to leverage tariffs as negotiation tools than impose them. Thus, this perceived threat might be less dire than many believe. In summary, while market volatility is a regular occurrence, investors need to recognize the inherent normalcy behind corrections. With a historical backdrop of 5% dips averaging 3 times a year and occasional pronounced downturns, fluctuations are an expected part of investing. The anticipated rate cuts from the Fed may arrive sooner than later, but all in all, maintaining an informed perspective on market trends and economic indicators will empower investors to navigate uncertainties and enhance their portfolio resilience. The Federal Reserve holds significant influence over the economy, with rate adjustments often reflecting broader economic conditions. While the current stance indicates a steady approach, unforeseen circumstances such as a hiring slowdown or market turbulence can change this narrative rapidly. Should these conditions arise, the possibility of an earlier rate cut in June or July becomes plausible, sparking a potential market rally that could catch many by surprise. The ramifications of an early rate cut would be profound. Current market expectations are not aligned with this scenario, as analysts predict slower adjustments. Any unexpected announcement from the Fed could lead to a rapid surge in stock prices, an opportunity that astute investors could capitalize on. Evaluating the potential for a rate drop reaffirms the importance of staying informed about market dynamics and macroeconomic indicators that could influence these decisions. In the realm of investing, Tom Lee's insights emphasize the incredible power of long-term strategies, with evidence suggesting that his top 25 stock picks have grown an astounding 130% over 4 years. The impact of a buy-and-hold philosophy becomes evident. While many traders fall prey to the elusive goal of market timing, Lee advocates for a disciplined approach, where patience and a focus on quality stocks reign supreme. For those seeking to refine their investment strategies, joining an investment community, such as Lee's Academy on Patreon, offers access to invaluable resources including research-backed stock picks and insights into economic cycles. The final reflection for investors centers around the notion that skepticism within the markets can present unique buying opportunities. Conversations regarding inflation may seem exaggerated. Thus, an understanding of the Fed's trajectory could inform crucial investment decisions. Investors should consider volatility as a normal aspect of market behavior, recognizing that those who practice patience frequently reap long-term rewards. Hence, as the horizon for 2024 approaches, employing a steadfast strategy focused on quality stocks will strategically position investors to thrive regardless of the economic landscape. In conclusion, remain patient and dedicated to your investing journey and embrace the opportunities that arise amidst uncertainty.